typically use a depreciation method called the Modified Accelerated Cost Recovery System, or the MACRS. MACRS. The IRS allows investors to deduct depreciation on a piece of residential property for 27 and a half years and 39 years for commercial real estate. Depreciation is categorized as a net loss on investment property, even if the property produces positive cash flow. Because the investors already deduct the cost of their rental property, the depreciation deduction offers investors an innovative way to save money on a yearly basis. The 1031 exchange. Name for the section called the 1031 of the IRS code, Internal Revenue Code. A 1031 exchange is a swap of one real estate investment asset for another. While the most investment swaps are taxable as sales, a 1031 exchange will have no tax or very limited tax at the time of exchange. For investors, this means you can roll over gains from one piece of real estate investment to another, avoiding taxes until you actually sell it a year later. To successfully complete a 1031 exchange, the investment property must meet the following criteria. The value of the replacement property must be equal or greater than of the re-signed property. Properties and transaction must be exchanged for some type of asset, such as real estate investment trust or a REIT. And the exchange property must be held for productive purposes in business or trade. Self-employment or your FICA tax. As a real estate investor, this tax benefit will save you on the income you receive from rental properties. FICA stands for the Federal Insurance Contribution Act, which is a 15.3% tax that is split 50-50 between an employer and employee. As a business owner or self-employed, you're responsible for the full 15.3% tax. However, depending on how you legally structure your real estate business, can actually be offset. Rental income is not subject to Social Security and Medicare taxes, also known as FICA. While this is not an enormous benefit when compared to other investments, it is significant when compared to normal earned income. If you earn money at a normal salary job, you pay 7.65% back in 2008 of your salary in FICA taxes. I'll just give you a example on FICA taxes. If you're self-employed, you pay 15.3% towards the FICA tax. With a $100,000 salary, that's $7,650 or $1,500,300 out of pocket from your salary. But if you earn $100,000 in rental income, you avoid that tax completely. This is a very big incentive to start earning your money from rental income. You can also live in your flipped property. What if you want to avoid capital gains tax altogether? Then just flat out buy and immediately move into your house as your principal residence. As long as you live in the home 2 out of the next 5 years, the U.S. can actually make a tax-free profit up to $250,000 as an individual, or $500,000 if you're married. A real estate strategy called Live and Flip takes advantage of the generous tax exemption. So keep in mind that this doesn't have to be a permanent strategy. You can do 2 or 3 flips, reinvest the earnings, and move on to other investing strategies. Another is installment sales for income and deferred taxes. The IRS gives property investors another tool to reduce taxes on the sale of real estate. This tool is called an installment sale, also known as seller financing or the seller carryback mortgage. Like the 1031 exchange, installment sales are only available to property investors and not to dealers, which are the house flippers. Also, like a 1031 exchange, installment sales allow an investor to defer capital gains tax. But unfortunately, the amount of accumulated depreciation must be recaptured at the initial time of sale. From a practical standpoint, an installment sale just means the seller of an investment property receives the sale over time. The seller is essentially extending credit to the buyer instead of the buyer getting a bank loan. For example, a duplex owner could sell a property for $200,000. $30,000 could be the down payment, and it would. And then not me, but the buyer could still owe $270,000 in the form of a seller finance mortgage. The terms of the financing might be $1,934 per month at 6% for 20 years. It's also worth mentioning that installment sales can be a great way to transition out of an active property management and into a period of more passive income. You can also own properties in a self-directed IRA. You're probably familiar with IRAs and Roth IRAs, which is a tax-deferred way to invest for retirement. What you may not know is you can set up your own self-directed IRA and use it to invest in real estate tax-free. But this isn't as simple as buying equities in a normal IRA. First, you must hire a custodian or a trust company to administer the self-directed IRA for you. They'll create the self-directed IRA and you transfer money to it. You can then create a legal entity like a LLC to buy and own investment properties. The self-directed IRA invests money into the legal entity as your chosen investment. Where it gets complicated is if you want to finance the investment property rather than buy it in cash. Financing is allowed, but it comes with some more important caveats. The loan must be non-recourse, which means that borrower cannot be individually liable, which many lenders just doesn't allow. Also, only the non-finance portion of the purchase is sheltered from taxes by the IRA. And of course, the normal IRA rules apply. You can't withdraw money before the age of 59 and a half, and you must start withdrawing by the age 70 and a half. Die in real estate. So this might sound a little weird, but one of the best plans, at least for a tax strategy, is to die or should I say pass away with your real estate. Instead of facing the tax issues of recapture depreciation or capital gains tax, whoever you have for in your last will and trust, whoever inherits it, will instead get a stepped up basis. So if you buy a rental house for $100,000 and many years later, like I don't know, 40 years later, you die, and the house is then worth $500,000 or $500,000. So when your inheritant or your heir sell the house, they would not pay any capital gains tax on the $400,000 gain. Instead, their basis would be $500,000 or $500,000, which means they could sell it for $500,000 and have no capital gains tax to pay at all. But keep in mind that inherited assets are still subject to estate taxes. Back in 2018, $11.18 million of assets are were exempt from estate taxes. So your heirs would inherit a lot of property before paying any taxes. Like that. So for investors, it's important to remember that there are multiple real estate tax investing benefits at your disposal. The barrier for many is understanding what's available and how to take advantage of it. Real estate tax benefits are extremely important for investors for long-term wealth building. Taking advantage of tax breaks will allow investors to stay on the path to financial freedom while sheltering themselves from the U.S. government. Always consult a tax professional for any questions you may have, or at least do your due diligence. And for the last benefit, and it's kind of obvious, but real estate is a piece of transferable property. You can transfer it to a beneficiary, particularly a family member, whether through your last will and testament for estate planning when you passed, or just for a gift. This is very critical, especially for building generational wealth to pass on to your lineage. And they will have all the previous advantages that you had when you took advantage of real estate yourself, and they don't have to start over from scratch, just like that. And of course, those are all the benefits to real estate investing. Now the downsides. Well, as with any investment, there are no absolutes in real estate investing. It's always important to understand that some of the areas where you'll need to exercise appropriate caution and do your own due diligence, or always ask for help, or at least partner with somebody who is also interested in owning a piece of real estate with you. So here are a few things that you might want to consider before you jump into real estate. Well, just how I always try to um, let you know is real estate is by nature a very illiquid investment. When investing in real estate, realize that real estate properties are considered illiquid assets. Something one person cannot easily sell or exchange for cash without a substantial loss in value. It is not that easy to sell a property that quickly. Most real estate transactions are done in private markets, where transactions with multiple bidders are slow and require a substantial amount of capital. Therefore, if you think that you need to convert your asset into cash quickly at some point, this just might not be the right investment for you. Many elements in the process are not entirely in your hands, not the least of which is the schedule. Another downside is the steep learning curve. If you do not have a real estate background, you will have to familiarize yourself with a variety of legal, financial, social, and commercial concepts as you begin investing in real estate. While you do not have to be a subject matter expert in every aspect of real estate, like the contracting, the mortgage process, and property management, it helps to familiarize yourself with the terms and ideas that are commonly used. That will allow you to make better decisions and consult with professionals in the field more knowledgeably. Understanding investment strategies is another way to ensure that you maximize the potential of your investment. Know how to find a great deal, what margins are required, and how to effectively maintain your investment are all areas where you may want to work with and have a mentor that you look up to or do some additional research for yourself. Property manage. If you've never been a landlord, you will need to develop marketing expertise and a understanding of the rules and regulations in your area, including the Fair Housing Act, which is a federal law passed in 1968, on top of the Civil Rights Act of 1968 or the Indian Civil Rights Act of 1968. There will be a fair amount of legal red tape to work your way through in many markets. In addition, late night phone calls and repair requests can be time consuming and a frustrating part of the landlord style. Should you decide that you want to outsource the management of your property, you will need to spend some time considering which property management company is right for you. It would be important for you to look at the impact a property manager will have on your profit margin. In addition, you'll want to comparison shop and find a management company that fits your goals and best serves your market. There is also tenant risk, like vacancy. Having your property in a vacant status, meaning that nobody's occupying your property, means you're not collecting any rental income. Vacancies can be an issue, which can actually disrupt your cash flow. In rental real estate investing, your property could be vacant for a extended period of time. Families grow and need a bigger place. You need to prepare the property for the next tenant and find and screen applicants before someone moves in. Vacancy can also be due to a can be legally problematic for you. So getting stuck with a bad tenant can be even worse than having no tenant at all. Some tenants will cause problems and will cost you money and valuable time wasted in court. If you own a rental property, your cash flow can take a significant hit if you end up renting to a tenant who doesn't pay at all, who doesn't pay on time. The tenant can leave the property in very poor condition when they move out. So it also asks the question, is the tenant able to pay for and repair the damages? For any property destroyed, be sure to make the tenant liable and the tenant actually pays for it. If the tenant cannot, and if you don't have the appropriate rental property or landlord insurance on your property, that's even worse financially for the investor. Tenants can also misbehave and you decide not to renew their annual lease, and then you have to evict them. And you may be stuck dealing with the eviction process, which is time consuming, costly, and just downright unpleasant for you. So, as a rental property owner, you want to have control over your investment. While you're free to buy property anywhere in the United States, each state has its own set of landlord tenant laws. While these laws generally favor tenants, in many states, there are some states that are actually friendlier to you, the landlord, or the investor. If you're searching for landlord-friendly states to invest in, there's actually quite a things that you want to look out for, like the eviction process. If you end up with a bad tenant who doesn't pay rent or has damaged your property, you may need to evict them quickly. In some states, the eviction process just might take months. In landlord-friendly states, however, the process is much faster and less complicated. Property taxes. Regardless of where you're investing in real estate, you're going to have to pay yearly taxes on your property. If you own a rental property in a state with a higher tax rate, you'll pay higher property taxes than you will for a property of the same type of size in a state with a much lower property tax rate. Rent control. This is a government-run program that places restrictions on when and how often rental rates can be increased. Rent control laws vary greatly based on city and state. Ideally, you want to buy property in a market that doesn't limit your rent rate or has more lenient regulations on rent increases. And as a real estate investor or landlord, it is also helpful to be cognizant of other rules and regulations related to lease agreements, lease termination, security deposit timelines, property access notice, maintenance, and repair issues. Depending on which state you buy in, these rules may lean toward your favor. So, the current landlord-friendly states would be Alabama, Arizona, Florida, Georgia, Indiana, Kentucky, and Texas are examples of landlord-friendly states. Another downside of investing in real estate, would be carrying costs and your exit strategy. Remember that the cost of ownership for an investment property is not limited to the monthly mortgage payment. Insurance, property taxes, management, maintenance, all these can add up and can cut into your profits. That means a month or two between tenants can result in significant out-of-pocket costs for which you will need to be prepared. Should you find yourself short of cash, you will need to develop a plan for either tapping into the home's equity or liquidating that asset. And liquidating real estate, especially property, is very hard and it takes a very long time to do. Should you have to sell a property, you could find yourself waiting weeks or months, maybe even years for a sale, especially if you have a tenant in place. Be prepared to have an exit strategy. If dealing with a difficult tenant, there is a lot in your control as a landlord to evict them if they have violated the lease or possibly use a lease termination to end the lease itself if required. You can also lose equity. You can also see your equity fall. A decrease in local home values is one way it can actually happen. So this usually occur due to economic conditions in the area, changes to the neighborhood, deterioration, or aging of the homes in the area, and more. Basically, if homes are selling less in your area, then your equity will fall as a result. So here are at least 3 ways you can actually lose your equity. Increasing your loan amount or the number of loans in your home. If you refinance your mortgage or take out a second mortgage or home equity loan, you will most likely decrease the equity too. 2 would be letting your home fall into disrepair. As your home condition depreciates, so does its value and the equity that you have on it. And 3, the third way that I know is the market change. Overall changes in your local real estate market and economy can also impact your home value and your equity. So if you're worried that you might be losing equity in your home, try talking to a local real estate agent. They can actually pull up local comparable sales to gauge your home's fair market value and make recommendations for how you should move forward. And those are the downsides to real estate investing that I know. In my opinion, out of all the downsides, it's actually more the steep learning curve, which is the biggest downside to real estate investing aside from the illiquidity. Because if you don't know what you're doing and you don't have help on your side, or at least somebody you know who knows real estate investing, it'll make your investment worthless to you, and it can actually cost you time and money like that. And this concludes part 1 of my real estate video. So for my next video, it's actually going to be the numerous ways on how you can invest in real estate. So I think this is actually the longest video that I actually did throughout the series, but I didn't want to make it too long, but I was actually trying to I was just giving you a whole lot of information. So this is actually part 1 of my real estate, and then of my real estate video, and then my next video, it should be the the second and last part of the video. So next part is mostly going to be what are the certain ways that you can invest in real estate. And I have a whole lot of ways that I'm actually doing some of these approaches on how I invest in real estate myself. So again, the next video is going to be part 2, and it's actually going to be on the ways how you can actually invest in real estate and a few ways on how I do it. So for now, this is Nathan L. Dawson Jr. with Dawson's Discussions. I'm your host, Nathan L. Dawson Jr., and I will see you next time for the next video, okay? And I would like for you to have a nice day and stay tuned.